Happy Tuesday out there, folks. This is Darius Dale here to present our macro minute for Tuesday, June 21st, 2022. Starting with markets this morning, we have stocks up, commodities mixed with crude oil leading, crypto up, dollar down, global bond yields up. Shifting to our market moving headlines, you got to Google the word unmoored this morning, at least I had to, just based on James Bullitt's commentary. So inflation expectations may become unmoored without credible action by the Fed, according to James Bullard. Obviously, he's been one of the most hawkish members of the Fed. He's the first Fed speaker of this week, with Jerome Powell's testimony tomorrow and Thursday taking the top billing. Thomas Barkin and Loretta Mester, Cleveland Fed, and I think Philly Fed are up today as well. Over the weekend, Mester said recession risk is growing, and then Chris Waller said he will support another 75 basis point rate hike in July if the data comes in as he expects. So let me just summarize all that. This is a Federal Reserve, as we've been saying for many months now, if you've been paying attention, that is very concerned about its credibility. It's equally as concerned about its credibility on long-term inflation expectations as it is about destroying the current rate of inflation. Those are two separate processes that I think investors need to understand. The likelihood that they over tighten is very high in the context of having two separate inflation mandates: one, credibility; two, the actual data. Number two, thanks for coming out, Wall Street. Appreciate y'all. Goldman said recession risk is rising. It now sees a 30% chance of one over the next year, up from 15% previously. Morgan Stanley also sees odds of a downturn. Its bear case assumes the odds of a recession are close to 35%, up from 20%. So markets down, let's call it 20% on the S&P, 30-something% on the NASDAQ. Russell, who knows? Bitcoin probably down 60, 70, 80% from the ties. And guess what? Wall Street thinks the recession risks are rising. Guess what, guys? The time to manage risk is when the recession probability goes from 0% to whatever the hell their models are spitting out now. It's not about managing risk from when it's at 30% going to 100%. You typically buy stocks and accumulate risk assets in recession. And guess what? If we get a recession, there will be no more bigger bull on the planet, both physically, because I am bigger than most Wall Street strategists, but also, rhetorically, just in terms of how loud and obnoxious we will be on the bull side of the trade once we get into recession. I honestly think recession is the bull case. We'll be on Macro Voices this week talking about that in greater detail. So check that out on Thursday. So one thing, I keep it moving here on Wall Street. I have to tip my cap to my friend Mike Wilson over here. Not all Wall Street strategists are lagging indicators. Wall Street, this guy's been well out front of this drawdown in the equity market with the kind of specificity in terms of the catalyst, in terms of the targets, in terms of the data intensity and rigor that will get you a job at 42 macro. And he's been nailing it. So I want to tip my cap to him. But he did come out this weekend and said the S&P 500 has to drop another 15 to 20% to 3,000 to fully reflect the scale of the contraction his team sees. The bear market will not be over until recession arrives or the risk of one is extinguished. So he's very much in line with our views on that. I said a few weeks ago on a podcast that I think on the Pomp Show, actually, that a recession is the actual bull case. If you don't get a recession, we will stay in this malaise for an extended period of time, because that means inflation's not going to come down fast enough. Our model, if you think about adding impact of recession, tightening liquidity, sees fair value in the S&P around 2,900. So not too far off from where my friend Mike Wilson has the number. But again, I don't think we're going to get down that low. I think the Fed will likely pivot. I think we'll do enough damage to the economy to break the back of inflation, both reported and in expectations, before you get there. But who knows? We'll see. And then lastly, RRP uptake, reverse repo facility, that equals more QT for all intents and purposes from the perspective of adding or subtracting liquidity from risk assets. So demand for the Fed's RRP facility will swell further as money funds need to, quote unquote, more stuff to buy. They have so much money and nothing to buy it with. They obviously don't want to buy stocks and bonds. They want to keep it in cash, but you can't keep it in cash in a bank account. We have billions and trillions of dollars on your balance sheet. You got to go somewhere. You got to go to the Treasury bill market. You got to go to the Fed's reverse repo facility. You got to go commercial paper market. And clearly the Fed's reverse repo facility, being a zero risk counterparty with higher interest rates than all the other counterparties, including the U.S. government, it's obviously the best place to go from a reserve manager perspective. So that continues to suggest that we're going to continue to see funds siphon out of the real economy and into this sort of made up facility that the Fed is currently siphoning $2.23 trillion from the real economy in. They're doing a good job of taking liquidity out of the markets, and it's obviously being reflected on the screens on a trending basis. Big movers this morning. Sorry about the long rant this morning, but I'm feeling sprightly this morning. Got some important meetings to the upcoming. Russell 2000, 2% up this morning, or right around, to down only 5% month over month only. I guess in the context of crypto, that's not that much. Bloomberg Agriculture Index down 1% to down 5% month over month. 10-year, 30-year nominal Treasury yield up 6 basis points to 35 basis points month over month. Shifting gears to our probable range processes and volatility adjusted momentum signals. U.S. dollar bullish VAMs. Not overbought anymore. It's at 1.7% downside with 1.3% upside in its probable range. Gold bearish VAMs. Still in the middle of its probable range, 3.1% downside, 2.1% upside. 10-year nominal Treasury yield bullish VAMs, no longer overbought either, minus 27 basis points of downside, 20 basis points of upside. High yield credit spreads, looking at the CDX market index, that's still neutral VAMs here. Still overbought with 110 basis points of downside to the lower boundary of its probable range. S&P 500, that is bearish VAMs, bounced off the lower boundary of its probable range, minus 2.1% of downside, 7.9% of upside, to about 4,000-ish on the S&P. VIX neutral VAMs bouncing off the upper boundary of its probable range, correcting from the upper boundary of its probable range with minus 24% of downside versus 12% of upside. NASDAQ 100 bearish VAMs also bouncing off the lower boundary of its probable range here, minus 4.5% of downside, 7.8% of upside. Russell 2000 joining the NASDAQ and S&P and bouncing off the lower boundary of its probable range with minus 2.3% of downside, 9% of upside. Bitcoin bearish VAMs had quite a cathartic move this weekend. We're back above 20,000, or at least narrowly above 21,000, but we obviously sniffed 17.5. The 17.5. Shout out to my man Quavo for that on that one. Over this weekend, with 10% of downside now to the lower boundary of the probable range, right around 19,000, 25% upside to about 26,000 there. So somewhat of a fairer fight than it had been in recent weeks. Been deeply oversold for a while. Ethereum bearish VAMs, minus 18% of downside, 30% of upside. Shanghai Composite neutral VAMs, finally backing off the upper boundary of its probable range here, minus 4.4% of downside with 1.9% of upside. WTI crude oil bullish VAMs. I had a smackdown on Friday, but now it's recovering, still oversold technically. Just looking at the probable range with 16% upside to 130. I'm not sure if we're going to get that. This might be the last time you get to buy the dip in crude oil. We shall see. Agricultural neutral VAMs here. Looks like it's starting to break down. I mean, this chart's, the slope of this line is very different than it was, kind of, let's call it 2-3 months ago. So let's keep our eye on this in terms of the degradation we're starting to see in market implied inflation expectations. We talked about that in Around the Horn this weekend. If you look at inflation swap rates across 2-year, 5-year, 10-year, you're starting to look at it across certain sectors of the commodity market, not the least of which is the bearish VAM signal here in industrial metals. That is oversold, however, minus 0.3% of downside versus 7.7% of upside. So with that, Darius Dale presenting our macro minute for Tuesday, June 21st, 2022. Best of luck out there this week. Have a good one.